Hello everyone, welcome back to our next educational video, Market Structure for Beginners. In the last one, we talked about technical analysis and confluence. Today, we are covering the one concept that changes everything, market structure. Because if you don't understand structure, you don't understand the market, you're just reacting to candles. By the end of this video, you will know how to identify trends properly, the difference between break-up structure and market structure shift, what a 4-hour market structure break actually means, how structure alone gives you bias and direction, and the most common mistakes. Let's get into it. So, what is market structure? Market structure is simply the way price moves over time. Price doesn't move in straight lines, it moves in waves. It pushes, it pulls back. It pushes again, it pulls back again. And those waves create swing highs and swing lows. When you zoom out, you start to see that price is constantly doing one of the three things: moving up, moving down, or moving sideways. Market structure is the framework that helps you identify which one of those is happening. And here is the key. Structure tells you who is in control. If price keeps pushing to new highs and defending higher lows, buyers are in control. If price keeps making new lows and failing to break previous highs, sellers are in control. If price keeps bouncing between the same levels without clear progress, no one is in control, that's a range. So, market structure is not about predicting the future, it's about reading control in the present. It's the market showing you who has strength, who is losing momentum, and where the battle lines are. Structure is the foundation. Indicators are just secondary tools. If you misunderstand structure, you'll constantly trade against the market. But if you understand it, you stop guessing, you stop reacting emotionally, and you start trading with context. That's why this concept changes everything. Now, let's get into what means higher highs, higher lows, and lower highs and lower lows. First of all, a higher high means buyers pushed price above the previous peak. And a higher low means buyers defended a pullback at a higher level. It can go as deep as the 886 fib, as we discussed in the previous video. This shows strength. It shows demand stepping in earlier each time. As long as this pattern continues, the trend is bullish. Lower low means sellers pushed price below the previous bottom. Lower high means sellers stepped in sooner during pullbacks. This shows weakness. As long as the pattern continues, the market is bearish. Now, let's talk about break-up structure. A break-up structure happens when price breaks a previous swing point in the direction of the current trend. For example, in an uptrend, if price breaks the previous high, that's a bullish break-up structure. It confirms continuation. It does not mean reversal. This is where many beginners get confused between break-up structure and market structure break, which market structure break happens when price breaks a key swing against the current trend. For example, in an uptrend making higher high and higher lows, if price breaks below the last higher low, that's not continuation. That's a shift that signals potential reversal. So a market structure is a possible change in control. Now, how to identify a market structure break? Step 1. Identify the current trend. Step 2. Locate the most recent protected higher low. Step 3. Wait for price to break below that higher low with a strong close. Not just a weak, but a clear break and a close through that level. In a downtrend is the opposite. You watch the last lower high. If price breaks above it, that's a bullish market structure break. So, market structure break means break of a key protected swing that confirms a shift in control. Also, one important thing to understand is that both break-up structure and market structure shift can be applied on any time frame. If you are a scalper, you might look for them on the 1 minute and 5 minute chart. If you are an intraday trader, you'll probably focus on the 15 minutes and 1 hour. And if you are a swing trader, the 4-hour and daily structure matter the most. The concept doesn't change, only the time frame does. Because structure is fractal. It behaves the same way whether you are trading small intraday moves or larger multi-day swings. Your trading style determines the time frame, but structure determines the direction. Now, let's make this powerful and talk about why does a 4-hour market structure break is so important. Because higher time frames control direction. On lower time frames, structures shifts happen all the time. The 5-minute can flip bullish to bearish in minutes, but the higher the time frame, the more weight the structure carries. If the 4-hour has been bullish for days, printing higher highs and higher lows, and suddenly we break below the last major high-low, that's a big deal. That's a potential macro shift. When 4-hour market structure shifts, daily bias can change, intraday setups flip direction, and liquidity targets change. Think of it like this. Lower time frames are the waves. Higher time frames are the tide. You can't fight the tide for long. That's why identifying a 4-hour market structure break is powerful. This is why top-down analysis matters. Let's talk about CISD. CISD stands for Change in State of Delivery. It's an aggressive form of structure shift confirmation. Instead of waiting for a full break of a major swing, low or high, CISD looks for internal structure. Think of it like this. Market structure break means confirmed structural break. CISD means early warning momentum shift. It's faster, more aggressive, but slightly higher risk. Traders who want earlier entries use CISD. More conservative traders wait for full market structure break confirmation. Now, how to identify a CISD? Step 1. Identify the current trend. For example, in an uptrend, price is making higher highs and higher lows. In a downtrend, is making lower highs and lower lows. Step 2. Locate the most recent protected higher low. This is the swing low that should not break if the trend is still healthy. And step 3. Wait for price to break below that higher low, but close only above the candle open, not fully above the candle wick. The internal break is your early warning. In the next slide, we'll go through protected swings and have a look at the chart to explain both market structure and CISD better. But first, let's talk about a protected swing. To properly define the protected swing, you need to identify the move that created the last valid higher high or lower low. In an uptrend, the protected swing is the higher low that led to the break of the previous high. That's the level buyers successfully defended before pushing price to a new high. In a downtrend, the protected swing is the lower high that led to the break of the previous low. That's where sellers stepped in before driving price lower. If that protected level breaks, it means the side that was previously in control failed to defend their position. And when control fails, structure shifts. Now, let's go on the chart and find some examples. We'll start with an uptrend. So let's take this part of price action here and let's identify the first higher high. First higher high was this one here. Let me get this one. Now, the low that made this high was this one here. The impulse here is what confirmed the continuation. That break created a new higher high. Now, price needs to hold this level in order to keep the uptrend. So this one becomes our protected swing low, because this is the level buyers have to defend before pushing price to a new high. As long as this low holds, the uptrend remains valid. And if you want to get in the trend and look for longs, you can use a fib retracement from that low to the last high, and you get a retest on a 0.5 fib. So here, the market structure break was the break of this high here, with this green candle close above the high. If we are to talk about CISD, then the break of structure would have been sooner, because we take the close of this last green candle here and not the high. And so we have one candle prior to that for the CISD. Let's rename this one as a CISD and this one as a market structure break. This is a difference between CISD and market structure break. On CISD, we are looking for a candle close above the close of this candle, and for a market structure break, we are looking for a close above the high of the candle, weak high or weak low in a downtrend. And from here, we can see that price keeps pushing up and doing higher highs and higher lows. Now, the next high it needs to break is this one here. So the protected low swing here is this low here, because this is the one that created the move that break the high and made another higher high. Same idea as before, we use a feed retracement to see common pullback areas, and if it's a strong uptrend, we need the 382 to hold, as it does in this case here. And so price continues to print higher highs and higher lows. Now the next one is this high here that needs to break in order to make a break of structure and confirm the uptrend. Now the last low that created the break of structure is this one here, so this one will be our protected swing low. Again, using a fib retracement from the protected swing low to the high that broke the last high, we get a deeper retracement into the 786. But as we talked about in our previous video, in retracement like this, in pullbacks, price can go up to 886, but it needs to hold this low here because this one is our protected low. If price came back below the 886 and below this level here, so this one would have been like this, then we have a break of structure to the downside, and the trend may potentially shift at this point. Now let's find an example for a downtrend, and we're going up. Let's see. From the last high, which was this one here, was our last high. The last red candle that made this high here, the last low, was this one here. So this was now our protected swing low that buyers needed to hold in order to keep the uptrend. But as we can see, they failed to do so. On the first attempt on this candle here, they managed to buy it back and keep the price in an uptrend, but they failed to do another higher high. So this shows us that price and momentum is getting weaker. On the second attempt, sellers won, and they broke the structure by closing a candle below this protected swing low here. When this happened, we use a fib from the high to the low that broke that structure, and we get a fib retracement golden pocket retest for an entry short. And from here, if we keep watching the price, it keeps printing higher lows and lower lows, higher low, lower low, higher low, lower low, because price fails to get back above the last recent high every time until here, where it does another market structure break, and with this market structure break, our protected low will be this one. This is the start of the move that break the structure. And from here, the impulse was pretty nice, because if we use a fib retracement until it pulls back, it doesn't even come to the 382. I think that's a 236, which is a very small correction. Yep, close to the 236. This small pullback here tells us that the trend is strong and we don't want to fade it. Think of the protected swing like a defense line. As long as the defense holds, the team is still winning. Once the defense breaks, momentum shifts. How structure gives you bias. You don't need 10 indicators. Structure already tells you the bias. If price is making higher highs and higher lows, we have a bullish bias. If price is making lower highs and lower lows, we have a bearish bias. If we have equal highs and lows, that means we are in a range. Structure always tells you, should I look for longs, should I look for shorts, or should I wait? Bias comes first, entries second. Now let's talk about some common mistakes beginners make. And we're gonna start with the first one, which is calling every break a reversal. And that happens when you assume that every time price breaks a level, the trend is over. Price breaks a previous high, reversal. Price breaks a previous low, trend change. But not every break is a structural shift. Sometimes it's just a liquidity grab, a stop hunt, a fake breakout, or just lower time frame noise. This is why context matters the most. You have to ask yourself, was this a major protected swing or just a minor internal level? Did it close strongly beyond the level or was it just a wick? A true market structure shift breaks a protected swing with intent. If you treat every small break like a reversal, you'll constantly flip bias and get chopped up. Structure requires patience. Mistake number 2. Ignoring higher time frames structure. This one destroys consistency. Beginners often trade only what they see on the 5-minute chart. They see a small market structure break, they short aggressively. But zoom out to the 4-hour and you'll see the overall trend is still strongly bullish. The problem is this. Lower time frame structure can shift temporarily, while higher time frame structure remains intact. That's called a pullback, not a reversal. If the 4-hour is still making higher highs and higher lows, then a bearish 5-minute market structure break might just be a retracement, a liquidity sweep, or internal consolidation. Always ask yourself, what is the higher time frame doing? Because the higher time frame has more weight. Lower time frames are used for execution. Higher time frames are used for direction. If you trade against higher time frame structure, you're fighting the bigger money, and that usually doesn't end well. Mistake number 3. Forcing structure where none exists. Another mistake is trying to label every move as higher high, higher low, lower high, and lower low, even when the market is clearly consolidating. In a range, price will constantly break small internal highs and lows. If you treat each of those breaks as meaningful, you'll convince yourself that the market keeps changing trend, but in reality it's just chopping sideways. In consolidations, swings overlap. Highs and lows are similar levels, and momentum is weak. When structure isn't clean, it's usually not a trending market, and if the swings aren't obvious, it's probably a range. Professional traders don't force structure, they wait for clarity. If you have to squint and convince yourself, it's not clean enough. So let's recap. Market structure shows control. Break of structure confirms continuation. Market structure break signals potential reversal. CISD gives aggressive confirmation. And higher time frames matter the most. In the next video, we are taking this one level deeper, multi-time frame analysis, and how to combine daily 4-hour and 1-hour charts properly. Because structure only becomes powerful when you align it across time frames. If you are serious about improving, make sure you're subscribed, and I'll see you in the next one. Bye bye!